Good morning, everybody. Thank you very much for joining us for this joint presentation with Beaufort Financial Reading and KRE Corporate Recovery. We're going to have two presentations today. The first one is going to be from Gareth of KRE, looking at directors' duties. And then the second one is going to be presented by myself, Ashley Hull of Beaufort Financial, looking at more the business owner's financial plan now and going forward. So to start with, we've got Gareth from KRE. KRE is an independent firm of restructuring and recovery professionals. They have 4 partners, all permanently based in Reading, and they have been operating in the Thames Valley for over 25 years, during which time they've built strong relationships with local accountants, solicitors, banks, and factoring companies. They pride themselves in that they will always look at the recovery angle as opposed to the insolvency angle of any situation, and will work with the management team of any company to find the best solution available the circumstances for stakeholders, including creditors and shareholders. So I'll now pass over to Gareth. If anyone has any questions, please write them in the chat box and we can go from there.
Thanks very much, Ash. I wrote this presentation back in April, within a week or two of the lockdown starting, and I've deliberately on the first slide left it up as April 2020 because when I wrote it we were all guessing slightly what the next few months would look like, and 2 months on I think we're still guessing really what the next few months will look like. I don't think there's any certainty as to how we'll head out of the lockdown. I think the next month will be quite crucial as the government eases its measures, in particular on the retail side, and I think they're just testing the water as to whether we can leave the lockdown smoothly or whether there'll be a further reversion to lockdown. So what I can speak about today is the fact that we've been advising businesses in this period of uncertainty for the last 2 months. So a lot of the suggestions I had 2 months ago have actually come into place, and I feel in a fairly good position to be able to explain to businesses who are listening in today the advice we've provided and the feedback to that advice, because I do appreciate, as I said at the beginning, that businesses are facing a further period of uncertainty. So what I'd like to cover today is the current position, what I think businesses can do to prepare for the return to normality, some warning signs. This is a slide from a presentation we did back in January to a bank locally as to what they should look out for warning signs for their customers potentially getting into difficulty. And most businesses will be able to tick the box of most of the warning signs. There's one on the slide that I want to bring to your attention, so I'm not dwelling on that, but just pick up one particular point, and then what directors can do if they are facing an uncertain future for their business to mitigate the risks that they face personally. So in terms of where we are at the moment, and remember this was written back in April, the government was very keen to talk about unprecedented times. I think what is absolutely abundantly clear now is that the country does face and is perhaps already in a fairly deep recession. What I think is important, because that's just stating the obvious and that's not a very helpful comment, what I think is important is how we exit the recession, and do we exit it as we did in the early 1990s? And I'm just about old enough to remember starting out on my career back in the late 80s, early 90s, or do we exit it as we did in 2008? And there is quite a dramatic distinction between the two. And then I'll look at what the future perhaps holds. The reason I compare and contrast the 1990s and 2008 recessions is that there is a lot of talk at the moment, and there's actually a paper issued this morning by the Institute of Chartered Accountants of England and Wales suggesting that whilst there's been a dramatic sharp dip into recession, they expect a fairly sharp exit from that recession, and that's akin to the 1990s. And what happened then was that there were quite a large number of corporate and business failures as businesses exited the recession. They weren't able to gear up for the quite pronounced upturn in demand for their products and services because they didn't have the cash resources to gear up to go out and buy raw materials, for instance. So what we found was that there were quite a number of corporate failures, but what that provided was a large number of opportunities for the stronger businesses out there, either to acquire failing businesses or to step into the shoes in the marketplace, in the gaps left in the marketplace for those businesses that had failed. So for the business owners listening today who are able to preserve their cash and are in a fairly strong position, and Ash will come on later to what businesses can do to prepare to have their businesses in the best shape possible. If we do come out sharply, yes, there'll be a higher number of failures, but conversely, there'll be big opportunities, I believe, for the stronger businesses to take advantage of the gaps in the marketplace. If, however, we don't come out sharply, as happened in 2008, and we bump along the bottom for a while, then I don't think that's going to be good news for the economy as a whole, because there'll be lots of businesses that can just about survive. Interest rates are low, banks aren't really in a position to make too many demands on businesses for repayment of loans. HMRC is fairly benign, and it will allow lots of perhaps failing businesses to survive longer, and consequently the opportunities for the better businesses won't be quite as pronounced. So I am fingers crossed that we come out fairly sharply. That's what the government thinks will happen. That's what a lot of economists think will happen. Only time will tell whether that's the case or not. But I think for the economy as a whole, it'll be a lot better if we can come out sharply. And certainly it will present plenty of opportunities for the strong businesses out there. In terms of next steps and what does the future hold, I've talked a bit about what the future might hold. No one's really certain. What is important is that businesses survive in this sort of period of uncertainty. And this slide talks about what businesses can do to survive. And let's be clear, a lot of businesses are in pure survival mode at the moment. I presented a webinar last week to the companies in the building trade, and they did a straw poll during that webinar, and over half the businesses who entered the poll said that their turnover in April, so forget about May, but just in April, immediately after lockdown, was over half, 50% down on what they'd previously forecast. So the good news against that reduction in turnover is a reduction in expenditure. A lot of businesses have effectively hibernated, kept costs to the absolute minimum. So whilst their income is down, also their expenditure is down, but that can't continue forever. As the government schemes start to reduce, expenditure will increase, and unless there's a corresponding increase in income, businesses will struggle. What we are advising businesses to do, and there is a bit of resistance to this, but it is worthwhile, is forecast on a worst case scenario, because you need to know how long your cash reserves will last for and how long you've got to put a restructuring or revival plan in place. And a lot of businesses have said to us, well, what's the point of producing forecasts? They're just going to be a disaster area. We believe it is important that you forecast and keep reforecasting as events change in your business, depending on what sector you're in, and you can see whether or not your sector is opening up in the economy, then you keep reforecasting. And the reason for that is, moving on to the third bullet point, is it is absolutely critical, and the businesses we've spoken to early in the lockdown have come back to us and said, yeah, it was the right thing to suggest, is engage with your stakeholders. rather than bury your heads in the sand and say, well, I don't know where my business is heading, so there's no point talking to anyone. It is important that you talk to your bank, your factoring company, your landlord, your investors, your key customers, your key suppliers, your employees, and engage with them and bring them into the problems you're facing and make it as much their problem as your problem. And the businesses that we spoke to in April, who are now coming back to us with updates on their positions, are saying that was the best suggestion we came up with, because it made them, the business owners, feel much better that they were sharing their problems with someone else and it wasn't just their problem. And if you keep your stakeholders constantly engaged with where you are on a weekly or monthly basis, depending on how important they are to your business, and keep providing them with updates on your financial position, if you do need to go to them for help, for further investment, for employees to perhaps defer part of their salary, for your bank to make a further loan, for your landlord to give you a bit more leeway on the rent when the moratorium on paying rent comes to an end at the end of this month. If you've engaged with them through the period, they will be much more receptive rather than going to them with a crisis and it's the first time they've heard from you for months. So we strongly recommend keeping everybody in the loop, even if it's not great news. When you need a bit of help, they'll be far more willing to engage with you. It is absolutely key, it's stating the obvious, to preserve cash and delay payments where you can. You have to look at what's critical, and you pay critical suppliers, for example. You pay your wages to keep your staff on board. If you've just got some historic creditors who are no longer critical to the business, then engage them and explain the fact that you can't pay them. Their recourse to legal proceedings is fairly limited at the moment. So I'm not suggesting that you just don't pay anybody, because if no one paid anyone, the economy as a whole would just dry up and come to a grinding halt. But engage with people and explain who you can pay and when you can pay them, and bring them into the troubles your business is facing. But you have to preserve the cash to last for as long as it can possibly last, because you don't know necessarily when your income stream is going to come back on tap. And as I said earlier, it's the businesses with a bit of cash reserves who will be able to take advantage of the opportunities and get moving again with your supplier chain and start reordering materials, and that will be good news for your suppliers. It's also perhaps an opportunity to strengthen management, bringing in, for example, a part-time financial director or financial controller. I know there's a cost involved, but again, it's a cost-benefit analysis that you need to know more than ever where you are from a financial perspective and understand where you are. And if you haven't got a decent set of accounts, you're not going to be able to answer that question. And also, there's a few people out there through places like the Financial Director Centre, the Turnaround Management Association, who might be willing to take stakes in your company rather than immediate cash, and provide that ongoing support. Because again, I think this is a time where you just need people around you to support you at this difficult time. Ash, I've managed somehow, thank you, to lose my slides. Thank you. I'm not going to dwell on all the government schemes available. You'll have had probably dozens of emails from all organisations, including our own, and many, many others, of all the schemes that are available. The one I'd just like to focus on, which hasn't really been publicised that much, is the third one down, which is a time to pay arrangement with HMRC. Everybody we have advised who has gone and requested a time to pay, mostly for unpaid PAYE, has been granted approval to that request by HMRC. So you've got the VAT deferral anyway to the end of June, but not sure how many businesses out there are requesting a deferral on their PAYE. And there is a specific helpline, a time to pay helpline, where you can call and ask for a time to pay arrangement for your PAYE and I guess corporation tax if you're lucky enough to have made a profit recently and have corporation tax to pay. But that is definitely worth picking up on, because that's the one that's not had a lot of publicity in the media, and there were quite a number of business owners we've been advising weren't aware of that opportunity. So that is something worth picking up on, particularly in July and onwards, when you start having to pay your VAT again. Then I'm not sure how sympathetic they'll be to a VAT deferral, given that you've already had one for 3 months, but certainly PAYE deferral is an option. And the last bullet point is deliberately the last bullet point. If you need protection from your creditors, then there are procedures available to buy a breathing space rather than it being the end of the line. And I'm talking there about a company voluntary arrangement or administration, where you can put a moratorium in place between you and your creditors and just buy some time. And for example, we're putting together a company voluntary arrangement at the moment, and it's hospitality sector, where the proposal to creditors is, we don't really know what the proposal is because we don't know what the future holds. But we either wind up immediately and there's going to be nothing for the creditors, or you give us 12 months to see how the land lies and whether there's a future for our company. So it's a means of buying time in a formal capacity if your creditors are starting to threaten to overwhelm you and the pressure's just getting too great. So very much a last resort, but there are procedures out there, what I call rescue procedures, rather than pure insolvency procedures, which includes the winding up of the company. There are means of just buying yourself some time in a formal capacity. If you've engaged with your stakeholders, as I set out above, and you're managing everybody, then great. But if your creditors are starting to build and it's all getting a bit out of hand, then you should consider what formal rescue mechanisms exist. I mentioned the warning signs. I'm not putting this up there for you all to say, well, they all apply to me. Of course they do. Everyone is causing me pressure. The one I put up, and as I say, this was a slide we presented to Barclays, I think it was back in January, is the 6th one down, lack of management information. It comes back to my forecasting point. And I know I'm an accountant and I'm not just trying to find work for accountants here, but the bank was most receptive to the customers who came to them potentially with some difficulties, but with good management information to say, look, we know where we are. This is where we think we're heading. Will you support us? Rather than, I've got a crisis. I'm facing a winding up petition. I'm facing forfeiture from my landlord, but I've no real feel for whether I'm making a profit or a loss or where I'm heading. So the reason I put the warning signs slide up is just to corroborate my previous slide that if you are engaging with your stakeholders, management information is absolutely key, because they will be more receptive if you can point to where you are financially at a given period and where you think you're heading, with plenty of caveats, because everybody understands there's uncertainty as to what the future holds. But if you can pinpoint where you are financially, you will get a much better reception, certainly in the financial sphere, than walking in the door saying, I've got a crisis, but I haven't really got a plan and I don't know where I am, etc. So that was the key point from that slide. And then we fully understand, and the reason we're getting calls from directors is they are nervous about their personal positions. What if my company does end up falling over? What are the risks for me personally? And in fairness, the government, whether you think they've handled or mishandled the crisis well, they have acknowledged that directors face a difficult time, and they brought in last week the I forget the full name of it. It's something like the Corona and Insolvency Reform Bill. It's a major piece of legislation that's likely to go through in the next couple of weeks unchallenged and become an act of parliament. And it's the biggest change to the insolvency regime in the last 20 years. And it's really to try and give the directors a little bit of comfort and a little bit of confidence that they don't have to immediately wind their businesses up because they're worried about their personal positions. But it does come with limited scope, so it's not a complete and utter bailout for directors. What directors need to consider is when the company's solvent, their duties are to the shareholders. However, where there is a risk of veering into insolvency, the duties flip and it becomes a duty to creditors, and they have to minimize the loss to creditors. And wrongful trading is a provision, it's a sanction against the directors personally, where they allow a company to continue trading past the point that they really should have taken steps to wind it up. And the government has brought in a 3-month suspension of wrongful trading for the period 1st of April to the 30th of June, that if you find yourself having to wind your business up, and you're criticised for allowing it to have continued past the point where you really should have stopped, you will not be penalised for wrongful trading and will not be held liable for any of the company's losses. But that does end on the 30th of June, so you're back on your own from the 1st of July onwards, and you really do have to consider, and if you only remember 2 words from this presentation, reasonable prospect are the key 2 words. Do you have a reasonable prospect of avoiding insolvency? And that is difficult at the best of times. It's even more difficult where you don't really know where your particular sector is heading in the economy. But that will be the test, that if your company does fail, did you at any given point have a reasonable prospect of believing that you could avoid being wound up? And what is key, and I'm sorry to go on about it, but is the financial information you hold. Because if you can point out to knowing where you were and where you felt with a reasonable degree of certainty you were heading back to forecasting accurately as you can, then that would be a huge defense, as opposed to I had no idea where I was and I had no idea where I was heading. Then any liquidator is going to say, well, how did you know you had a reasonable prospect of surviving? So that is the absolute key words from today. And it's worth considering that as a board every day is probably a bit extreme, but certainly weekly. Do we still have a reasonable prospect? And again, if you've engaged with your stakeholders and you've told them the difficulties you're in and the plans to get out of that difficulty, then that is a huge defense, as opposed to putting your head in the sand and no one had a clue where you were financially, and you were just carrying on taking credit from suppliers without any real knowledge of where you were financially. So whilst you're safe, in inverted commas, for 3 months from any criticism, April, May, June, come July, the old rules apply. And if your company does fail in the fullness of time, you have to demonstrate that you carried on because you had a reasonable prospect, and you have to demonstrate why you believed you had a reasonable prospect of surviving. Because what you don't want to end up with is your company failing, you're disqualified as a director, you've got a liquidator on your back for wrongful trading, which can incur personal liability for certain losses, and you've got no defense. So my final point is a repeat as many times as you can. Produce good information, document your decision-making processes, and that will be your main defense. But do it now, because in 6 months' time, you won't remember what you were thinking back in May, June, July time. But if you do it now, then it will form your defense if the worst happens. Let's say you've got a bit of government backing, but it is quite limited. It doesn't get you off the hook completely if your business fails. And the mantra is understand where you are from a financial perspective, forecast as accurately as you can, and document your decision-making process as a board, and that will be your defense if the worst happens. But really, to end, I'd like to focus more on the positives, If your business does need a bit of help, there are rescue mechanisms in place that mean you don't have to wind up your business immediately. But if you can engage with your stakeholders, preserve your cash, the economy will open up. And if the economists and the chancellor is correct, and we have a sharp upturn in business activity, yes, the weaker businesses will fail, but for the stronger businesses who survive this difficult period, there will be significant opportunities in the marketplace to take advantage of. That is me done, Ash, so probably back to you.
Thank you very much, Gareth. It's very informative, very useful, and some definite points that we'll all be thinking of when speaking to business owners. I can't see any questions in the chat box. I don't know if that's been due to the slight technical glitch we had. If there isn't any, I'll continue on with my presentation. If you do have any questions, please get in touch either with myself or with Gareth, and we can go through these another day via email or via phone, whatever works. So now let's quickly flick through. Yeah, lovely picture of the KRE team. So I work at, for those who don't know me, I'm one of the independent financial advisors at Beaufort Financial, and I'm going to look at sort of business owners from a personal side of this in terms of what they should be doing, both for themselves and for the company. So really, I'm just going to go through three points: what we do at Beaufort, what business owners should be doing, and how has really COVID-19 affected business owners with everything that's going on. So at Beaufort, we are independent financial advisors. What that means is we are a fiduciary for our client. I think the easiest way to explain what a fiduciary is, for those who don't know, in terms of financial advice, is if a client rang up the pension provider and said, I need a pension, the pension provider would sell him a pension or her a pension. As a fiduciary, what we actually do is we look at the client, we find out what they're looking to do. Financial Conduct Authority always say you've got to know your client. It's one of their biggest bugbears. It's really, is the advice you're giving suitable for them on a bespoke level? What we then do is we then take all the information from the client, not just hard facts in terms of what they earn, what they've got in their bank account, what they spend, but also going forward. What is the plan? What is the retirement? What's the plan with your business? Are you going to sell it at retirement? Are you going to become a sort of silent investor in it and still receive an income? What's the goal? What do you want to do in retirement? Is it move abroad? Whatever it may be. So what we then do with all of this information is we put it into a cash flow software we use. That not only looks at the client now, but also the client going forward. So this is actually two business owners, a husband and wife who own a business, very profitable business. Everything currently looks brilliant. Sort of where the orange line is, that's actually where they're retiring. And after that is where they want to live in retirement. The red is shortfall, meaning that actually they can't fund their retirement even by selling their business at the value they think it's worth. Very often when we speak to business owners and we ask them about, okay, you've got this business, everything's going really well, but actually what's the plan? How are you going to fund retirement? And the answer we've heard numerous times is, my business is my main asset, my business is my pension. Well, what we can do is we can show clients actually what happens if they do sell their business for the value they think it's worth. Does this fund the lifestyle they want to live going forward? In this case here, as you can see, it doesn't do that. But this, for us, it opens the client's eyes a bit. It stops them just going, well, life's really good now. These clients, got a lovely house, they've got a good business that's making money, got children in private school, things like that. And, on day to day, they're very happy. They think the life's really good, but actually selling their business for what they think is currently worth now doesn't actually let them live the life and retirement they're currently living and also want to going forward. What we then do is we then go away and we discuss, potential options moving forward, things that they should be doing, which I'll come on to in the next slide. Another thing we can also do for them is we can work out what they need to sell their business for to fund retirement to fund their retirement, or for example, how much regular savings or what the investment rate of growth is. So in this example, the client said they wanted to retire at 55. In reality, it's just not feasible. There's too much shortfall. If they wanted to retire at 55 and not spend as much money, that again is actually something they could have done. But they said, well, actually, we want to maintain our current standard of living. So they said, well, actually, it might not be 55, maybe it'll be 60. Let's plan for 60. So in here, we've got them retiring at 60 and a bit of other advice in terms of what they should be doing and the benefits around it. And actually, in this case, we worked out for them to cover their shortfall in retirement, they need to sell their business for £5.2 million. They think their business is worth about 2.5. So actually, they've gone away and thought, well, actually, maybe, yeah, the business is going to form a massive part of our retirement, but we need to look at other options as well, because otherwise we can't do what we want to do. And that's really what financial advice is about. It's about helping clients achieve their goals, whatever they may be. On the flip side, if this client had a business worth £5 million and they only needed to sell it for £3 million, potentially they might not work as hard, but at least they then know what they've got coming up, as opposed to just living sort of a day-to-day life thinking that everything's going to be okay when potentially it might not be. So really, the plan that we've been through with clients, and this is a conversation we're having a lot with clients at the moment, is what should business owners be doing? Stick to the plan. Everyone always says stick to your plan. It should always work, short term and long term. In the short term, whether that's regular savings, pension contributions, whatever it may be, if you can afford to do it as a business owner, you should keep doing it. There are cognitive biases that state that if you earn, say, £100,000 and you say you only spend 70, well, actually the other 30 will probably get spent unless you have a purpose for it. So if you continue to do those monthly savings, if you can, obviously, then that's a real benefit for the business owners now and in the long term. Two things that we say to business owners, two things they should always do: pension contributions and relevant life or key person protection. The reason for pension contributions are a tax deductible business expense. It's deemed as being the most tax efficient way of moving money from a company into your own hands. Should anything go wrong with the company and the company fold, anything that's in the pension won't be counted as part of the company. Again, relevant life in simple terms is life cover for business owners. Be paid for by the business, it's then paid into trust, so it doesn't form part of the individual's estate. And again, it's a tax deductible business expense, so no corporation tax on the payments. So how has COVID affected business owners? Some businesses obviously aren't trading, they may not be open. What's going on? And the plan now may look different depending on what the business is, and it's very, very individual circumstances. It's a great time now to look at the plan and maybe think, what are you going to do going forward if this goes on for another 3-6 months, maybe a year? What's the structure of the business going to do going forward? Are pension contributions still feasible? As I've said in the previous slide, if you can keep contributing into a pension, yes, brilliant, you should keep doing it. But pension contributions don't have to be monthly, they can be lump sum. And actually, with a lot of clients, we're saying that completely understandable, now is a time to hold more cash. The pension contributions you're making, brilliant, but if you need to hold that cash, that's definitely the right thing we should be doing. But it's a chance to almost write an IOU to say, actually, look, this next 6 months going to be very tough. I want to hold on to more cash. Well, in 6 months' time, if things have picked up, and fingers crossed they do, and we're back to the new normal or whatever it may be, that could be an opportunity further down the line to go, I have missed out on 6 months. Let's do them as a lump sum. Life cover, relevant life. I explained the benefits of it. Now more than ever, it seems that it's a discussion point. People are obviously worried about what's going to happen, what happens especially if you've got key members of staff. You can have what's called key person insurance. That basically pays the company a lump sum of money to make up for missed profits from the key person being unable to work, which right now is a big worry for a lot of firms. Again, reviewing the plan now is the only way to find out how it's going to affect the individuals over that longer period of time. Is it retire later? Is it potentially change to financial goals? What else has changed? What else has happened? Is the plan still to sell the business? Do you think the individuals think they're going to get the same value for it? And it's really, they're very, very bespoke answers to questions that only the individuals know the answer. But has other parts of the plan changed? Is it still to pass on money to children, as an example? Can we still achieve these goals? Because for clients who are currently invested, you only have to read the news to see that markets are down. I would say that actually, if you speak to most clients who've looked at their portfolio, it's probably not as far down as the news is making out. And for a lot of people, actually now, if you are still okay in the long term now, when markets are at a depressed level, going forward, that in theory there may not be an issue. If you can still achieve all your financial goals with markets at this lower end, it's potentially for them, and speaking with them, it's giving them a lot of reassurance, knowing that actually markets are down, but I'm still okay long term. And what else is required? You know, we speak to clients about holding cash, especially within their business. What is going to, we always say, what's going to make not keep you awake at night? Pension contributions are brilliant, but if by doing so you're worried you're running your cash reserves low, then now isn't the time to do them. And it's really about making sure we understand what it is they're looking to do, what the clients want to do, what business owners are trying to do, both personally and with their business, to making sure they can be efficient both with their own wealth and also with money within the business. And that is everything from me. Again, can't see any questions in the chat box. If anyone's got any, if you could quickly write them and we can go through them. If not, I would like to thank everybody for joining us, and I hope you found this really useful. This has been recorded, so we will be able to send you a copy of this. Also, if you do have any questions after this, please do get in contact either with Gareth or myself, and we can go through those with you. And I would also like to massively thank Gareth for taking time to co-host this presentation. It's been very informative and very useful. So thank you everybody, and stay safe.